The impact of the Federal Reserve's reliance on economic data creates uncertainty that is transforming the dynamics of financial markets. When we talk about volatility, we often imagine sudden changes in stocks or economic indices. But rarely do we connect these fluctuations to the decisions made by one of the most powerful central banks in the world. The truth is that the Fed, by basing its actions on shaky economic data, puts investors and companies in a constant race to predict the next move. This dependence generates a domino effect throughout the market, causing a frenzy of adjustments and bets, where no one wants to be caught by surprise. Why does the Fed choose this uncertainty route? And how long will this approach be sustainable? The essence of the problem lies in the nature of economic data, which, by their very definition, is unstable. Data such as inflation, employment, and GDP growth can fluctuate significantly from one month to the next, and what appears to be a trend in one period can easily reverse in the next. This creates a trap for the Fed, which reacts to numbers that are often already outdated by the time policies are implemented. Volatility arises when the market tries to anticipate these reactions, and any unexpected variation in the data can cause a real earthquake in investors' expectations. This cycle of uncertainty keeps the market in constant turmoil, causing both large players and small investors to make rash decisions, often leading to irreparable losses. But what makes this situation even more volatile is the market's perception of the Fed's words and actions. At each meeting, the financial market waits not only for political decisions, but also between the lines of the leaders' speeches. A single word can inflame or calm the markets. This kind of reaction shows just how sensitive the economic environment has become, with each economic indicator being widely dissected for clues about the Fed's next move. We are therefore in a vicious cycle where data and the interpretation of the Fed's intentions generate peaks of uncertainty and tension. Critics of this dependence argue that the Fed needs to find a new way to deal with data. The volatility generated by these constant swings not only hurts investors, but also undermines public confidence in long-term monetary policy. Companies that rely on sound economic forecasts to make investment and expansion decisions face increasing challenges in drawing up strategic plans. Uncertainty can eventually stifle economic growth, as long-term planning becomes nearly impossible when the macroeconomic landscape is constantly changing. So what would be the solution to this dilemma? Economists suggest that the Fed could consider a more stable approach, perhaps based on medium to long-term targets, rather than adjusting its policies based on monthly fluctuations in data. In addition, clearer and more direct communication with the market could soften expectations, reducing the impact of volatility. But until these changes occur, we are all at the mercy of the Fed's swings in data and responses. The question that remains is, how long will the markets endure this roller coaster ride before more severe consequences emerge?